it is important for founders to be clear around what do they need the capital for. We will ask them, they'll have to have a plan. And I think therefore, when you think about a tailored credit solution or capital solution for founders, having that clarity of why do I need that capital? What am I going to do with that capital? If you think about what we do as a business, we make investment decisions. We find businesses and we try to provide the capital to the right businesses that we think are going to succeed. We're getting people from diverse backgrounds who have got diverse perspectives, diverse upbringings, diverse educations, geographically, language, etc. That only serves to improve the decision making because you're getting more views, you're getting more perspectives. Ultimately, there is a lot of publicity, particularly in B2C use cases around Gen AI, and there has been huge progress made, obviously, in the last few years. But when you look at B2B use cases, they are still relatively limited within certain areas and certain segments. And so, the concept of, which I think is prevalent within venture capital, of investing in a pure AI play is not something that we've done previously. Never say never, but we've never done that so far.
Hi everyone, it's Akansha Dimri. I'm the founder and editor-in-chief of Tech Funding News. We cover startups, scale-ups and investment. And today we are at the beautiful office of AshGrove Capital, which does tailored investments into pan-European startups, especially mid-sized and small-sized. And we have with us Jonathon Ferguson, who is the co-founder and partner of AshGrove Capital. Hi John, lovely to meet you. How are you doing today?
Very well, thank you. Thank you for having me.
Thank you so much for being a part of TechTalks with TFN, which is becoming so popular now. And to start with, I would really like to know about AshGrove Capital and what you do. And you have two more founders, Elka and Phil. You founded in 2019, I suppose. So tell us everything about that.
So we founded the firm in 2019. Phil and Ilka and myself have known each other many, many years, almost 20 plus years, and have been in the industry for that length of time. And the whole strategy behind AshGrove was to found a firm that really addressed the funding gap for growing software and B2B recurring services businesses across Europe. If you think about that landscape, on the one hand, you've got thousands of really interesting companies that are growing with hugely talented founders that are looking for capital to support that growth. And what we've seen over the course of our careers is a lot of that capital, and a lot of that credit capital in particular, focuses on much larger businesses, much larger transactions in the debt capital markets across Europe. And when you think about providing, call it 10 to 50 million euros of financing to these businesses to help them grow, there's a massive undersupply of capital. And that's been structurally the case and growing, or that supply has been diminishing for more than 20 years. And having seen this trend over our careers, that was really one of the founding pillars of our business. And then I guess the second piece is to be a specialist, to be solely focused on backing software and B2B recurring services businesses. Half our portfolio is with founders, half is with VCs, growth equity investors.
Interesting.
And ultimately we feel it gives us a huge edge, right, in understanding people's business model and how they are going to use that capital to help drive growth.
That's very interesting. You're not a VC, of course. You are providing tailored investments. So, and they're flexible as well. So maybe there are founders who might not know about AshGrove Capital and the kind of investments you're making. Would you like to explain that? What is the process and in which part of the market do you fit in over here for them to understand more?
Sure. So at its core, we're providing non-dilutive growth capital to founders. So we're providing capital that they can borrow over the course of 5 to 7 years or 4 to 7 years. And that allows them to invest in their business. That could be investing in new product, in R&D and sales and marketing, entering a new market. It could be buying a little bolt-on business, a small business for them to add to their existing company. Or it could even be to help them in cleaning up their balance sheet, maybe taking out an old angel investor or something similar. So there's quite a lot of uses of proceeds, but the common theme when people take our capital is to drive growth. And so we are providing that growth. It's not in competition with equity. Often it's complementary to growth equity or to venture capital. But we allow founders to access that capital without giving up control of their business. And as I said at the top, one of the important things, certainly when we sit across the table from a founder, is you've got to understand their business. And it's helpful, I think, we understand all of the various subsectors within software and B2B recurring services, but we're founders ourselves. We started our own business. We understand, the kind of the burden on, not just on time, but on the pressure around driving growth and managing a team. And so I think being independent and having that ability to communicate on that level with founders and make quick decisions to give them the comfort that you can deliver is super important.
Interesting. I'm just trying to understand, how is your capital founder friendly over here? And when you are giving them non-dilutive investments, so what is at stake at their end?
Yeah, so ultimately from the perspective of a founder, I think that the key couple of points I would make is clarity of vision, right? and clarity of purpose with that capital. So, perhaps in contrast to an equity round, sometimes an equity round is raised with multiple purposes that perhaps are kind of in square brackets, not quite clear, but creating a valuation event for certain other shareholders to exit, and then some capital is raised. I think it is important for founders to be clear around what do they need the capital for. We will ask them, they'll have to have a plan. And I think therefore, when you think about a tailored credit solution or capital solution for founders, having that clarity of why do I need that capital? What am I going to do with that capital? How is it going to enable me to grow my business quicker? Which levers is that going to really address within my business? And what is my business plan? If they can answer those questions, it will be hugely suitable and accretive to them. And what that enables us to do is be a really powerful partner with them in their business. And that comes in two ways typically. One, obviously we're a capital partner, we're providing them with capital to accelerate their business. But the second way is, and this varies by each relationship and each portfolio company, is trying to add value beyond just that capital. So we sit on roughly 2/3 of our company's boards as board observers or board seats. And that can take the form of just attending boards and providing our views as required. It can be far more involved. It can be providing views on go-to-market strategies. It can be helping them source perhaps non-exec directors, maybe even helping them source M&A. And so there's a range of different ways we partner, but I think those two attributes of clarity of purpose and clarity of use of proceeds and clarity of business plan, that's very important when you're taking capital from a tailored capital solution provider.
I think as a founder, I will also take capital only when I get some kind of network, because as a founder, you always feel that, okay, it's easy to get capital, but to get into certain networks, especially if you're a diverse founder, it's difficult, especially in the global scenario. So how is AshGrove helping in that when you say that you're providing a lot of inclusion over there?
Yeah. So I think the first thing to say is that from our perspective, and the way we think about our business internally, is that the diversity and inclusion in our business it's not a nice to have. It's an essential ingredient around how we operate. Why do I say that? If you think about what we do as a business, we make investment decisions. Right? We find businesses and we try to provide the capital to the right businesses that we think are going to succeed. When we're making decisions, therefore, the most important thing we're doing is taking all of those different views and perspectives from our team and when you're doing so, getting people from diverse backgrounds who have got diverse perspectives, diverse upbringings, diverse educations, geographically, language, etc., that only serves to improve the decision making, because you're getting more views, you're getting more perspectives, rather than just one type of opinion. And we are big believers that the best investment decisions are made collectively in that kind of spirit of inclusion and that spirit of participation. We do the same when we look at companies. So when we're sitting on the opposite side of the table from a founder or a business, we're looking at what is the diversity of not just geographical background or ethnicity or gender, but the thought process. How have you got people simply from the finance industry? Have you got people from operating backgrounds? Have you got people from different diverse thought patterns? That's super important, because again, it enriches the decision making within that business. So for us, actually thinking about the businesses we invest in as well as our own business, it's super important to foster that inclusion and diversity. And then the final point I would make is, when you think about the wider tech ecosystem, one of the points we talk about a lot is that the ecosystem in Europe is relatively fragmented. You know, the sophistication of the ecosystem in Europe is still relatively uneven across geographies. And what we try to make sure we do when we attend conferences, when we meet counterparties, when we're traveling across Europe, we are constantly trying to repeat this message that there are alternatives and alternative sources of capital than simply just equity and simply, if you like, conventional forms of capital. And so it's making sure the ecosystem is included more broadly across Europe, as it is frankly in the US. And so inclusion for us goes across all of those parameters.
That is a very good point that you raised. And also, I want to understand over here that how different is AshGrove Capital in the market when it comes to giving capital to the startup founders, to the other models, while also VC, while also something which is similar to your firm.
Yeah. So I think when you talk about VC and growth equity, it's also important to bear in mind that, you know, these can be complementary forms of capital, right? And so, you know, venture capitalists and growth equity investors, they're looking to make a certain return. Typically, they're investing a minority or a majority stake in the business, and they're taking a board seat, excuse me, and have therefore a certain return target and certain impact at the board. That typically is facilitating growth, or that is obviously creating a valuation event. The difference with our business and the difference with our capital is really can be a passive capital injection into the business. We're not diluting the founders. We are sometimes, as I said, invited to join the board as a board observer, but that is not necessarily the case on every single transaction. We are not always equity holders within the business. And so our capital, in terms of the shape and the economic impact on the business, is different. That said, the return and the growth that people can derive from our capital is the same, right? Because if you given £1 from a venture capital firm and from us, if you can turn that pound into £2, the maths is still exactly the same. I would say when you think about other debt providers or credit providers in the market, as we talked about at the very top, typically speaking, they're focused on much larger transactions, much larger deals. We don't see that many players in our space, given the size of the businesses that we look at. But I would go even further and say, we certainly do not see sector-focused specialist thematic investors like us. And again, this is super powerful when you're a founder, because partnering with someone who truly understands your business and day in, day out, all they do is look at software and B2B recurring services businesses, is very powerful and allows us to add value beyond just as I said, just beyond just capital, but it means you're not going to be in that position a year down the road where maybe there is some sort of bump in your journey. Perhaps the growth journey isn't always up and to the right. Having someone that understands your business and understands the levers that drive your business model is actually pretty critical. And I would say, without speaking about others, having a truly specialist, focused investor rather than a generalist is in that case pretty important.
Interesting. I'm just trying to understand over here that how do you invest in startups? How do you see that, okay, this is the one which I'm going to choose to invest in to give a ticket size of 10 to 15 million from your fund?
Yeah. Well, first thing is we do have a minimum. So we typically won't invest in businesses that are less than something like 5-6 million of recurring revenues. And so there is a minimum size. And so businesses for us need to be of a certain size because they need to demonstrate that even if they're growing at 60, 70, 80%, they could be structurally profitable if they so chose to grow slightly slower. And so what's important from our perspective is businesses that can demonstrate that through their growth rate, their cost base, through the efficiency of how they use capital internally, in other words, how efficient are the unit economics within their business, and also how strong are the retention metrics. Ultimately, if you're looking at the software business and they lose 25% of their customers every year, that's pretty difficult for us to assess and to underwrite that growth. If the churn rate is 5% and the business is growing at 40-50% and it's a very sticky product, that is ultimately something that we typically find much easier to underwrite. So there's a multitude of pieces that go into the melting pot around how we get comfortable with these businesses. But I would say that kind of financial metric stability is really important. And typically speaking, that always comes from product. There is no substitute for really, really good product that has good market fit, genuinely solves the issue for a customer, and that is sticky.
Okay, so do you invest in products? If there is a choice of a nice founder, a very interesting founder, and a very interesting product, what would you choose?
It's a great question. Ultimately for us, we are looking at the product, the quality of the recurring revenue that's coming from that product. We're looking at the customer base, the granularity of that customer base. So we're looking at the quality of that recurring revenue. And those are all intrinsically linked. The founders are important, of course they are, right? And so we are always going to look at the clarity of that founder, the ability for them to assemble a good team, their passion, their vision. And typically what you see in good founders is actually quite a good alignment here. They're obsessed by product, they're obsessed by customers. And so what's actually quite pleasing is that there is a natural alignment between what is a good founder, inverted commas, and a good product. And I'm the first to say we don't say yes to every single deal. And there will be great products that are going to do fabulously well that won't fit our risk profile. But typically I would say they're the kind of attributes we see in terms of product and founder.
Yeah, I think that it should be the right mix, but founders are very important at the end of the day. I think it's my perspective that there are a lot of great products in the market, but it's the founder. But I'm not a VC or an equity firm. But moving on, so I also want to understand about your current portfolio and what you're planning to invest in.
Okay, so at the moment we're investing Fund 2. Fund 2 is 650 million euros. We're just over a third invested through that fund. And Fund 2, rather like Fund 1, is still, we're providing 10 to 50 million euros of financing. Again, roughly 50-50, founder-led businesses to growth equity or VC-backed businesses across Europe. Within Fund 2, I would say the themes and trends we're seeing and continue to see are very interesting dynamics in the Nordic market. So the Nordic ecosystem has always been a really great opportunity set for us, both founder-led and driven by growth equity investors. We have recently closed a couple of deals there, as well as doing 2 or 3 deals over the last 2 years.
Which one is that?
One that's only just been announced, or will shortly be announced. The other one is just closed but hasn't been announced. So I'll have to update you afterwards on that one.
You also mentioned about the second fund. Is that announced already?
The second fund was announced, yeah. Okay. So the fund 2
that was in 2023.
2024. At the end of 2024, yeah. And so the Nordic region has been a really happy ecosystem for us, and we continue to see huge traction in our forward pipeline there. I'd say the same about the DACH region. We've had great success over the last 12-18 months in Fund 2 in Germany. That's obviously, it is a big economy, it is a big hotbed of the tech ecosystem, but increasingly we are seeing great attraction there. I'd say the UK has always been a strong market for us, but perhaps less in the forward pipeline there, and actually opportunistically in places like Spain, France, the Benelux in particular, we've seen some quite interesting increases over the last 6-9 months in terms of opportunity. What about
Netherlands?
In the Netherlands, yes, yeah. I was there this week, and I think there is some optimism really around the growth equity scene in the Netherlands, and you've got a very strong founder community in the Netherlands as well.
I was there as well for 2020.
Yeah.
And I lived in Amsterdam for 3 years, so yeah.
Okay.
So I know a bit of it. But Lovable, Spotify, everything, Sweden. Are you planning to invest more in the Nordic region as compared to the other parts? Or is it like a phase investment that you're planning?
We're driven by the opportunity set that we see. Okay. So what we won't do is almost weight geographical regions and say we will invest 25% here, 15% here, and 20% there, and stick to that rigidly. We need to be opportunistic, and we need to be thoughtful around the relative balance of the opportunities that we see at the given time. And so, whilst we can never accurately predict precisely how the forward pipeline will convert, those kind of guidance themes I've given you are really based on the week in, week out analysis we do on our CRM. And so we track both the interactions we have with counterparties as well as the meetings and the actual opportunities and deals that we see. And that level of activity, if you like, is a good leading indicator to the deals that are coming. And so that's why I kind of called out immediately the Nordic and the DACH region. There are other areas of Europe that are really interesting to us. Ireland would be a great example, actually. Not as big a market, but a really interesting entrepreneurial market with some great software businesses in particular. We've closed a couple of deals in Ireland over the last 6 years. And so whilst not as big a market as the DACH, again, it's an area that we certainly would never ignore. And so we can't be that rigid in trying to think about how we allocate capital across geographies.
Yeah, Ireland is interesting as well. We are doing a couple of partnerships with companies over there. Trust App is one of them. Understanding your perspective on the categories you are getting into for B2B software, AI is one category that no one is, leaving it out. And I think at your sides, it becomes difficult to assess a startup that they are using AI just for AI washing, or they're actually implementing it. Yeah. So what kind of assessment is there on your end to keep a check on that and then invest? Yeah.
So the topic of AI is obviously raised an awful lot, both by counterparties we speak to in the market, but also by our investors. I'd say a few things. So firstly, every single portfolio company we have has AI embedded somewhere within their product, whether that's a software business or a B2B recurring services business. I would very much differentiate, however, between generative AI, large language models, and what I describe as functional machine learning that is actually being used by customers. Why do I say that? Ultimately, there is a lot of publicity, particularly in B2C use cases around Gen AI, and there has been huge progress made, obviously, in the last few years. But when you look at B2B use cases, they are still relatively limited within certain areas and certain segments. And so, the concept of, which I think is prevalent within venture capital, of investing in a pure AI play is not something that we've done previously. Never say never, but we've never done that so far. And ultimately, the question mark, I think, in my mind is, if you were to invest in a pure play Gen AI model today, how do the unit economics play out over the next 5 years? Because when you think about businesses like OpenAI, people who don't know the answer to that question, and they're the biggest operators in this whole space. And so I think there's still a lot more to figure out in terms of the economic profile of the pure play Gen AI players. That being said, every single one of our, as I said, portfolio companies has some element of AI within them. Every single one of them is investing in their R&D roadmap in furthering AI and embedding it in their product and in their customer proposition, whether or not the customer is adopting it or not. And the interesting thing when we reflect across our portfolio is adoption by many customers, particularly large enterprise customers, is very slow. Still significant fears around data security, significant fears around how that data will be used, where it ends up, how the actual product works. And so, there's a lot of proof of concept going on, there's a lot of POCs, a lot of pilots. But the idea that we would, or that we certainly at the moment will invest in a pure Gen AI product, that feels a little way off. And then flipping the kind of question on the other side, we talk about AI every single investment committee and probably every pipeline meeting we have internally as a team, because as you rightly point out, it's here to stay. It's in everything that we think about. So to give you a live example, we were looking relatively recently at a workflow software business that takes third-party, relatively open source data and ingests that data and puts it into a workflow and uses AI to make that workflow for a company more efficient. When you think about those elements, actually what they're doing 10 years ago was probably deemed relatively complicated and actually a pretty useful and mission critical use case. Clear ROI for the business in terms of saving headcount and efficiency. Now, that could probably be spun up, a similar business, inside a couple of months. And so what happens to the price of that product, that software product? How difficult is it to ingest that data? It's becoming easier and cheaper every day that goes by. And so in our mind, we have to be incredibly careful as investors when we look at opportunities and think about the disruptive power of Gen AI and how that impacts future investments, but also our existing portfolio.
I think it's an industrial development era which has come back. So while everyone was very scared at the industrial revolution era, it's the same thing. Yeah. And I also believe that AI is going to generate a lot of new jobs. LLMs, people are just going to be more advanced in certain time period. That's my perspective as a media publisher. So yes. So John, we would also like to get your perspective on the geopolitical situation over here as someone who is investing in companies. I think there's a lot of talent flow which is going to happen in UK. What do you think about that, and how positively are you taking that trend?
Yeah, look, I think it's a good point. We are certainly hearing and feeling there is a even greater sense of excitement around the opportunity set in UK and Europe, and that's both, I think, talent and capital. So the first, capital, I think over the last maybe 10, 15 years, historically a lot of capital has been focused on perhaps the US, and I think actually what we're seeing is people very alive to the opportunity set within the UK and Europe, and actually some of the stability, both regulatory stability, geopolitical stability on a relative basis, we have to be clear about that, means that capital is increasingly flowing, I think, into the UK and Europe, and I think with that comes talent, right? And I think, every country, every geography is different, but there is a real, there is a very, very talented and real universe of both founders and players within this whole ecosystem, within the software and tech ecosystem. And one of the things, as I said earlier, we talk about a lot is how do we actually deepen and broaden some of the capital and funding options available to these businesses and these people. But I think at the moment, and we never quite know what the geopolitical future holds, but that migration, if you like, of capital and talent, I think is very real, and we've heard that from counterparties in the market. We've heard that from investors. And then one other thing.
I was about to ask that, is the investment committee already talking about the H-1B situation in US right now? And then I also saw over the weekend some of the CEOs went on LinkedIn and said, we have 4,200 jobs available in the UK. Anyone who needs sponsorship from US can come over here. I mean, Trump making crazy announcements. So is this conversation already happening about how the landscape will be in 2 years?
Well, I can tell you in real time that a CEO did bring it up with me last week. So yes, the conversation's happening. I guess I would be slightly cautious to predict where we'll be in 2 years' time, because I'm not quite sure I know where we'll be in 6 months' time. So I'm not quite sure about that piece, but I certainly think that, both investors, but also if you think about founders investing their capital within their business, allocating capital, they're also looking for stability, right? They're looking for regulatory stability, they're looking for signaling from governments, they're looking for an understanding of what the rules of trade and of decision making may be, whether that's tariffs as one example. And so I think to ensure that people are making decisions and they're buying services, products, whether that's software or others, there needs to be this confidence and this certainty and stability. And so in some senses, geopolitical volatility or uncertainty around where things are headed is not helpful for founders, for perhaps the businesses they're trying to sell to. And therefore ultimately investors will pause, right? And we've seen that in terms of some of the M&A volumes over the last couple of years. Investors have hit the pause button a little bit. But I do think the counter to that, to paint the positive, is in times of volatility, whether we go back to the financial crisis, whether we think about periods even earlier like the dot-com boom, if you are agile and you have capital, there are very interesting opportunity sets available to you. And certainly when, again, we talk internally around our business and we think about opportunity sets and how they evolve and how quickly they can evolve, volatility can be a super interesting time to invest. And I think the same is true for founders, right? And they can sometimes find real opportunity within value accretive acquisitions they can make. Small bolt-ons of teams, that could be a technology tuck-in. There could be an opportunity, a window to enter a new market. And so even though times are tough and the macro environment is challenged, and certainly growth is slower than it was 2-3 years ago, there is always opportunity sets within that. And I think it's just being agile and focused on identifying them.
True, there's always an opportunity somewhere. And so, on that, what will be one piece of advice that you would give to startup founders in this volatile market right now?
One piece of advice. I think the piece of advice I would give to one piece of advice I'd give to a founder in this market is focus on the capital efficiency and the discipline in your business. Ultimately, staying true to that discipline and understanding the levers that drive your business, and being very disciplined around how you allocate that capital and how you think about the return on that capital and how you drive growth. I think that will put you in good stead. Ultimately, it will insulate your business from minor shocks. I think ultimately, when it comes to raising capital, whether you're a credit provider or you're an equity provider, you're going to look at how well the founder has navigated and thought about that decision-making process. And so for me, I think that discipline, that understanding and that focus, I think is the real key. It preserves optionality for you. It preserves all of your optionality and gives you the ability to, as we just said, right, be agile. And if you need to raise capital, whilst insulating your business from perhaps continued geopolitical volatility or macro uncertainty as we go forward.
Yeah, I think discipline and perseverance is very important, and also just being very resistant and stable, basically, for what you're working with. Consistent was the word. And also, AshGrove, what are your next steps? And is there a third close coming in very soon, or what does the future look like?
We are laser focused on still investing Fund 2 and actually realizing Fund 1, which is actually coming back at pace, which is fabulous for our investors. Ultimately for us, we're focused, rather like founders, on remaining disciplined, remaining focused on the task at hand, growing our business. We're almost 25 people now here in London.
Do you have offices in Europe?
We do not have offices in Europe as of yet. We have a pretty big platform though, focused solely on, as I said, software and B2B recurring services across Europe, and that platform will grow, right? And that's both on the investing side of our business, but also on the functional side, whether that be legal, investor relations, HR, finance and ops. And so, again, rather like any founder, we're focused on making sure that we deliver on what we say we promised our investors, in the same way that when we deal with founders and counterparties on the investing side, we make sure we deliver and we act on and deliver on what we say we'll do. And so from our perspective, certainly over the near term, that's the key, and ultimately making sure that all of those decisions and all of those, if you like, milestones, we hit them and we do that in the right way.
Thank you so much, John. It was lovely talking to you, and I think we covered all the perspectives of what AshGrove is and what are you planning and what are your future goals and what kind of startup founders you're looking for. And thank you so much, everyone, for joining us at Tech Talks with TFN, another episode of very interesting one. And hope you subscribe and like this video and also our channel. See you in the next one. Thank you. This is Akansha Demri signing off.